All right, so now we're going to talk about inventories and cost of goods sold. Let's start out with a definition here. What is inventory? Well, it's the goods that are owned by a company and that are held for sale to customers. And so you have to distinguish that from, let's say, equipment that you might sell during the course of operations every once in a while. Yeah, you're going to sell it, but it's not something that's regularly held for sale to customers. So that's what distinguishes inventory from other types of assets. Remember that we capitalize the cost of inventory. We put it on our balance sheet as an asset, and until we sell it, we don't expense it. And so we list it as inventory, and once it's sold, it becomes part of our income statement as an expense account called cost of goods sold. And so I think we've looked at this before, back when we were talking about merchandising, the fact that in our income statement for merchandisers and manufacturers, the income statement has several different things in it that are different from like a service company. Service companies don't have this thing called cost of goods sold. They just have revenue. So for manufacturers and merchandisers, their income statement accounts for the cost of goods that are sold, the inventory that's sold, and so they list revenue less cost of goods sold equals gross profit, which of course less operating expenses equals net income. So that's what that looks like. But the main thing here is that we capitalize the cost of the inventory, and then we expense as cost of goods sold once that inventory is sold. Now, there's a couple of types of inventory systems. One's called perpetual, the other's called periodic. And by far, probably the most prevalent these days is the perpetual inventory system. And so with a perpetual inventory system, we enter in the accounting records our purchases of inventory, we add it to the inventory, and as the merchandise is sold, its cost is removed from the inventory account and transferred to cost of goods sold. And so this is pretty important to managers to be able to track their costs as it's happening. Now, the other periodic inventory, all we do is we simply list our purchases in a temporary account called purchases account, and then we wait till the end of the accounting period and figure out what our beginning inventory is. You would know what your beginning inventory is. You do a physical count to figure out what your ending inventory is, and you know the amount of stuff you purchased during the year. So you add beginning inventory to your purchases during the year to come up with cost of goods available for sale. And then from cost of goods available for sale, you subtract the ending inventory that you determine from your physical count. And the difference is your cost of goods sold. So that's done once a year. I would imagine as sophisticated as even smaller companies have gotten, and with tracking, inventory tracking being what it is these days, much easier with barcodes and stuff like that. Probably there's more and more companies going to perpetual, and fewer and fewer going to stay with periodic inventory system. All right, so here are some typical journal entries. When you purchase inventory, you're going to list it as inventory on your general journal, debit, and of course, assuming you buy it on credit, you're going to credit accounts payable. Now, and of course, you know, when you pay the accounts payable with cash, you simply debit the accounts payable and credit cash, right? On the sale date, you track the sale, the inventory that's sold, and so you credit the inventory and you're going to debit this expense account called cost of goods sold. So pretty simple. Now the question here is, which unit did we sell? If you have multiple units, they may have different unit costs. You know, prices are always fluctuating. So what you buy something at today may not be what you buy it at a month from now. More likely, it's changed. And so the question is, when there's fluctuations like that, how do we account for this? How do we determine which units we've sold as this cost of goods sold? Just kind of a side here, the fact that we usually have subsidiary accounts to account for our inventory, and so you would have a subsidiary account for, like in this case, portable generators listed, and pretty specific information here. And while this looks like a piece of paper, this would also look like what it would look like in computer form as well. Now note here in this example, what do we have? Well, we have two items that we purchased at $1,000 per unit on January 5th, if you're looking at the first four columns. And the total of all those units, 5 of them, is $5,600. And notice, again, unit costs for 2 of them, $1,000 per unit, and unit cost for 3 of them is $1,200 per unit. So question is, which units did we sell? So, because it's going to make a difference in our cost of goods sold, and thus it's going to make a difference in our remaining inventory, right? Because if we use the first, let's say we sold 3 of them. If we use the first 2 plus 1, we've sold those items for $2,000 plus another $1,200, right? $3,200. But if we use the last 3 as the cost of goods sold, our cost of goods sold would be $3,600. So it definitely makes a difference which items we account for. All right, so because it makes a difference, FASB has come up with some acceptable ways of determining inventory flows, what we would call cost flow assumptions. Now there's 3, well, there's really 1, 2, 3, 4 types. Talk about. The first is this specific identification method of cost flows. We'll talk about first in, first out. We'll talk about average cost, and we'll talk about last in, first out. All right, so specific identification. Here you're going, just like the name sounds, you're going to specifically identify which items you sell. And so in this case, on March 1, this company, Mead, sells one of these Elko generators to Boulder Construction for $1,800 cash and uses specific identification. And so they have to determine which item they sold. They would normally do that by barcodes, by some identification number, something like that. And so in this case, this example says that the cost of goods sold for the March 1 sale is $1,200. And so this leaves, of that $5,600 total cost, since you're taking out $1,200 and assigning it to cost of goods sold, that leaves you with 4 units at a total cost of $4,400. That's 2 units at $1,000 and 2 units at $1,200 each. And so your entry when you make this sale, remember they sold it for $1,800, and I guess in this case it was cash, so they would debit cash $1,800, credit sales $1,800. Now you're accounting for the cost of the goods sold, and the assumption you're using is specific ID. So debit cost of goods sold and credit inventory for $1,200. And again, the point here is that you're going to make a similar entry. Of course, this may be accounts receivable instead of cash up top. So point here is that similar entries are made for each sale. Now, another cost flow assumption that is allowed is called average cost method. Now, before we go there, let's talk about a couple of things. When would you specific identity? Well, usually companies that sell large ticket items that are high profit margin. You sell a Maserati. Well, you're going to use specific ID method of cost flow assumptions. You're going to know what the cost of that particular Maserati that you sold, and you're going to take it out of inventory. Well, what if we sell bananas? Would we want to use specific ID for our banana inventory, or our doll inventory, or put anything in there that's small, it looks alike? They use the word homogeneous, meaning they're identical. I mean, it would be crazy the cost of tracking each banana or Barbie. So, for that reason, specific ID is only used for large ticket, high profit items like Maseratis. And so we have these other cost flow assumptions that we use for these smaller ticket items that you could track, but the cost of tracking them would be outrageous. And so in this example, they use one of the other methods, cost flow assumptions, called average cost method. One other thing before I go here, I keep backtracking. Well, okay, I'll talk about that in a few minutes. Average cost method. Here, you're going to just average the cost of all items that are in inventory. And so in this example, they take basically the same example. You've got total cost of $5,600 for the 5 items in inventory, these generators. And with the average cost method, you're going to take and you're going to average the cost of all those and divide that. Well, you're going to total the cost and divide that by the number of units that you've purchased and divide that by the total cost of those items. So in this case, the total cost was $5,600 for these 5 items. So you divide that into 5 and you come up with a average cost of $1,120. Now, if you're using, well, what you're going to have to do here is every time you make a purchase, you're going to have to average in that new purchase with the other items that are in inventory. So like, they had the 2 generators in there as of January 5th. And of course, the average cost, since they're the same, would have been $1,000, right? once they got in these 3 new generators at 1,200, look what they did. They averaged those at $1,120. So there's going to be a rolling average every time a new purchase is made, so you can average it with the inventory that's already on hand. And so note here that the average cost per unit must be computed prior to each sale. Now the next cost flow assumption, and so if you look in the book, they didn't do it, but if you look in the book, let me go back there. Notice that they sold this at $1,120, whereas with specific ID, they picked out the unit that they sold at $1,200. And so notice that cost of goods sold for specific ID was $1,200 and left a ending inventory of $4,400. But here, using the average cost method, cost of goods sold is $80 less, and ending inventory after the sale is $80 more. So ending inventory after the sale is more. Cost of goods sold is less by $80, which means you're going to have a gross profit of $80 more with average cost in this example. All right, let's go to first in, first out. Just like the name says, you're going to choose the first items in your inventory that you've purchased. Now, here we have 2 units at $1,000. We sell 1 unit, and so we're going to take that out at $1,000. So our cost of goods sold here is $1,000. And so what does that do to our gross profit? Well, it makes it go up even higher than either specific ID or average cost. It also makes your ending inventory, the remaining inventory, more, $4,600. And last but not least, pardon the pun, last in, first out. Now we call first in, first out FIFO and last in, first out LIFO. And so here we assume that the last items that we purchased are the first ones sold. Okay, why in the world would you do that? Again, these are cost flow assumptions. This has absolutely nothing to do with the actual movement of inventory. If you have inventory that is, can spoil over time, like bananas, you want to get rid of the oldest inventory. Otherwise, it's going to spoil, and you got a real problem on your hands. Nothing worse than stinky bananas. But yet, we are allowed some flexibility here by GAAP to assume the last items we purchased are the first ones we sell. Why did they allow that? Well, there's an argument that since prices rise over time, that the last items we purchase are more likely the reflective of our cost of goods sold, since that's what it's going to cost to replace them or something like that. I mean, is it a good argument? I don't know. I could see that there are some reasons why you don't want to do this. In the international accounting arena, LIFO is not even allowed. So we're about the only country that allows LIFO. So notice here we sell one unit at $1,200 because that's what we purchased those last three at. We take one out of inventory. Now, recall, we may actually, generators probably aren't going to deteriorate very fast, but I mean, we still might want to get rid of one of these generators at $1,000, even though the cost flow assumption is that we've actually sold one of these at $1,200. Okay, so the actual physical flow may be that one of these went out instead of one of the 1200s. But yet, the cost flow assumption under LIFO says we got rid of one of those last three that we purchased. I know it's confusing, but that's the way it works. And so here, our unit cost is higher by $200 than FIFO, which makes our ending inventory lower by $200. Means our gross profit is $200 less under LIFO. So why would you want to use LIFO? Well, again, the argument is that it better matches the most recent sale with the most recent purchase. I don't know how good of an argument that is, but from a practical standpoint or from an operational standpoint, what it does is it lowers your gross profit if you use LIFO when compared with the other example, the other methods, the other cost flow assumptions. If you lower your gross profit, you're going to lower your net income, which, oh, by the way, lowers your tax liability, which helps your cash flow. So it depends on what you want. Depends on what management wants. If you want higher profits, do LIFO, do FIFO. If you want lower profits but better cash flow, do LIFO. If you want to just split it down the middle, do average cost. If you've got big ticket items, use specific ID. It's just kind of up to you. Whoa, what happened? Once you choose to use a certain cost flow assumption, The consistency principle says that you must follow that. You must be consistent in using it in subsequent periods, unless there is a valid reason for the change. And so, why do we have this consistency method? Well, if we were allowed to just, 1 year decide we want to do FIFO because revenues are kind of down and therefore profits kind of down, and we want to maximize our profit the best we can, and then next year we have a great year, so we're going to choose LIFO because we don't want to pay so much in taxes on that profit. Not consistent. The other problem is for external users, the users of these financial statements, the comparable statements from one year to another are not consistent. So once you pick a particular cost flow assumption, you've got to stick with it unless there is a valid reason why you have to change. Does that mean that, let's say you have several types of inventory. Think of Walmart. I mean, a super Walmart has bananas, but it also has, TVs. And so, if you have different types of inventory, can you use a different cost flow assumption on different types of inventories? Well, yes, absolutely. You could, if you wanted to, for TVs, do specific ID because they're fairly high-priced, large ticket items. And then for, bananas, you could use LIFO or FIFO or average, weighted average. So it's just kind of up to management how they want to do that. Now, a lot of firms have gone to what we call just-in-time inventory systems. Remember where inventory is in your financial statements. It's considered a current asset. It's something that's going to be used up and converted to cash within the next 12 months. But once you buy inventory, it's not liquid anymore. As a matter of fact, if you buy the inventory and it sits there, you've already had an outlay of cash, and if it just sits there and doesn't sell, it gathers dust and doesn't do you any good. And so a lot of firms have gone to this just-in-time inventory so that they don't have inventory sitting around on their shelves gathering dust. And so it refers to completing goods just in time to ship to the customer. It can also refer to purchasing it just in time to sell to the purchaser if it's a merchandising sort of situation. Now, we talked about the fact that with the perpetual inventory system, we're constantly doing ins and outs with our inventory. We buy inventory, we account for it as inventory. As we sell inventory, we account for it as cost of goods sold. And so your records are fairly accurate. Okay. Now, Does that mean that we don't take a physical inventory when we select perpetual inventory? Because if you recall, I said that when you choose to use the periodic inventory system, you must take a physical inventory at the end of the year to figure out what you have left in ending inventory. And the answer is, even if you have a perpetual inventory system, you need to take a physical inventory. Well, why is that? Well, I think I've said it on more than one occasion that the biggest perpetrators of theft in an organization are employees. Doesn't mean it couldn't happen from outsiders. That's definitely true. But by far, employees are the biggest thieves stealing from companies. But regardless of who does it, you could have a discrepancy in your records, in your perpetual inventory records, due to theft. And that's usually the biggest discrepancy, is due to theft. Now you could have, depending on the type of product you sell, you might have spoilage. Certainly that would be true with bananas. Or you might have breakage. And so what happens if you take a physical inventory and the physical inventory is less than your inventory in your periodic inventory records? Well, you're going to make this journal entry here. You're going to debit cost of goods sold for the difference between the two. Let's say your ending perpetual inventory shows $2,000 of an item, and when you do the physical inventory, you only come up with $1,800. Well, here you're going to debit cost of goods sold for the difference of $200 and credit inventory $200 to bring inventory down to its actual level of $1,800. Sometimes, hopefully not often, but sometimes the value of our inventory goes down. And so that could happen from obsolescence, could happen due to the quality. But for whatever reason, if the value of the inventory goes down below the cost of that inventory, this idea of lower of cost or market comes in, and we must reduce our inventory to the lower of that cost or market. We have to adjust the inventory value to current replacement cost. Okay? Now notice it says current replacement cost, not what we could sell it for. Okay, so that's a little different than maybe what you think of market as. Most people think of market as what you could sell that product or products for, but here market means what it would take to replace this item of inventory or items of inventory. So there's a couple of different ways we can do this. I don't want to spend a lot of time on this, but you can apply this to individual items, you can apply it to inventory categories, or you can apply it to total inventory. And if you, in this example, you've got this company who has their cost of each item. They've got ski equipment and ski accessories. And here you've got the individual costs of the two types of ski equipment. They have two individual items at $16,400, and then ski accessories, two items as well. And so you can do this a couple of different ways. You can do this as individual items, and what you would do is compare the cost to the market value of the individual inventory items. And when I say items, I mean like categories of, subcategories of inventory. And so in this case, under ski equipment, you have one subcategory of downhill skis. You look at the lower of cost or market. Here, market's more than cost, so you're going to pick cost, $16,000. But the other subcategory of cross-country skis, market is less, so you're going to pick the lower of the cost or market there, or $3,000. And then you're going to go down to the next group of subcategories, boots and jackets, and the lower there is the market of $1,500. And then below, the lower is the market as well. And so you total up all those individual items and you come up with $26,500. If you go by category, category here is the total of all subcategories under ski equipment. Well, if you add up the subcategories, the cost is $20,000 of those two subcategories under the category of ski equipment versus $21,000 market. So you pick the $20,000 inventory category, and then go down below to ski accessories, and there the lower of cost or market is market of $7,500. So there you're going to come up with a different figure of $7,500. Then another option you could have is just, well, is total inventory cost less or more than the market value? Well, or put another way, is the market value of the total inventory less than cost? And the answer is yes, by $500. And so you could certainly value it that way. So there's three different things you can do. You have some options with this. Here they're talking about goods in transit. Basically what you have to know here is that when goods pass to the buyer, they hold title. And so depending on how these goods are shipped and what the terms are, determines when title passes to the buyer. If the terms are what we call FOB, free on board shipping point, that means that the title passes to the buyer at the point of shipment. And you know, you got this truck here going this way, right? So they picked up goods back here at the point of shipment, and you know, they're going down the highway to the buyer's destination. at that shipping point where they picked up the goods, once those goods are on the truck, title passes to the buyer when the terms are FOB shipping point. If it's FOB destination point, title passes to the buyer at the point of destination when it gets to the buyer or wherever they designate it's going. Okay? So another reason why this is important, let's say these goods are on their way at the end of the year, and that's what this is showing here. Well, what do? Whose inventory are these goods that neither the seller or the buyer has, this third-party shipper has? Who records these goods in their ending inventory? Well, it depends on whether or not it's FOB shipping point. If that's the case, then the buyer is going to record those in their ending inventory. If it's FOB destination point, the seller is going to record that in their ending inventory. Like I said, moving to periodic inventory systems, probably not used very much anymore, but to the extent it is, what you do, instead of moving stuff into inventory account, you're going to move it into this temporary account called purchases, and that's going to build up throughout the year. And then at the end of the period, you're going to deal with that. There's no entry for cost of goods sold. You're simply going to make one big entry at the end of the year for cost of goods sold after you've made your physical inventory, figured out how many items of inventory are still in ending inventory. From that, you can figure out your cost of goods sold, and then you're going to make one big entry at the end of the year for cost of goods sold. So, tell you what, look over that. Look over the examples there on periodic inventory so that you understand how that works. But, you know, kind of works the same way as far as the cost flow assumptions are concerned. It works pretty much the same way, so not a big difference there. All right, so that's it for Chapter 8.